You have intangible property, traditionally we think of that in terms of licensing, trademarks, know-how or knowledge, customer lists, business ideas. So anything more nebulous that usually gets licensed between two related parties. You have services, and you think there's all types of different services. You have your general back office type, routine type services, just day-to-day stuff, or your high value services such as research and sales and manufacturing can be a type of service as well. So that we definitely cover off on those. And don't forget, last but certainly not least, when two related parties are lending money between each other, that is covered off on by transfer pricing fundamentals. Lately, we've heard a lot of tax authorities refer to transfer pricing as the fair share of operating profit or taxable profit between related entities. I guess that is an appropriate definition, but really what's that fairness based upon? So in order to come up with what is fair, we have to do a functional analysis. So that means looking at both parties to the transaction, figuring out what they're doing, what they should be earning, figuring out what the risks are, because one would expect that the higher and more risks an entity assumes and the more complex functions that it performs, it would expect a higher rate of profitability. So really the functional analysis is the foundation for any transfer pricing analysis. And I mentioned this also because we're going to mention this we'll get back to this at the end of the presentation, but it just kind of is really important. Moving on, why does transfer pricing matter? Well, we have different tax laws, different rates varying by countries. And so there creates this natural friction between companies seeking to minimize the taxes they pay, trying to move cash around efficiently, and really what we see most often is just trying to avoid any penalties or doing anything wrong, or especially paying double taxation. Is really what we see. And the friction there is against tax authorities who are obviously trying to maximize the tax revenue in their local jurisdiction, and they're trying to prevent companies from purposely avoiding paying taxes and shifting profits to lower tax jurisdictions where they would not have to pay as much tax. And they're trying to enforce something called arm's length intercompany pricing, which we'll talk about in a second as well. So that's why transfer pricing is important. Finally, I like to cover off on what I consider two universal principles for transfer pricing. So I call them universal because you'll come across these anywhere in any country that has transfer pricing regulations, which most developed countries do now. The first is really the arm's length standard. And what this says is that a related party transaction should really be priced as if the transaction was between two third parties or a related party and a third party. So ultimately, it's a market-based price because it's what the transaction would have been would it have taken place between two third parties. So that's it in a nutshell. The second universal principle you'll find is really the best or most appropriate method. So the US transfer pricing regulations, every local country's laws related to transfer pricing, the OECD guidelines, they all prescribe a host of methods in order to develop that market or arm's length price. And they all say, listen, there's not a hierarchy. You need to actually figure out what is the best method here and describe why it's the best method, and more importantly, prove why the other methods aren't really the best or better methods. So in any transfer pricing regime, you're gonna have to come up with what is the best or most appropriate method and be able to defend them. So just level setting there on transfer pricing. Amy, that brings us to our first polling question.
All right, we're going to launch our first polling question here. Why is transfer pricing important?
Interested in maximizing taxes collected in their jurisdiction, potential for tax saving. Most countries have transfer pricing documentation requirements, or all of the above. These got cut off a little bit, Amy, just so you're aware. Awesome. 91% of you got it right. It's all of the above. So tax authorities are looking at, interested in maximizing the tax they collect. There's tax saving potential for transfer pricing, and most countries have transfer pricing documentation requirements. So moving on to the topic of today, transfer pricing under US tax reform. So in general, not a lot has changed to transfer pricing regulations in the US. So we could just end the presentation now and move on. No. So really, when it comes to technical and statutory changes, really all that happened was kind of an expanded definition was added in regards to intangible property. And I'll mention why a little bit later on when we're talking about some of the actual new tax laws when it comes to the Tax Cuts and Jobs Act, or TCJA, or U.S. tax reform. So they really just expanded how the definition of intangibles. Well, they expanded the definition, I should say. And there's a couple of opinions, and I have my own opinion on this. One of the opinions that's out there is that it helps kind of reverse some recent unfavorable court decisions when it comes to intangible property and some of the costs that make up some of the payments thereof. But really, I think my opinion is that in order to pass some of the, or I guess enact some of the other laws that they passed under the U.S. tax reform, that they had to kind of broaden the definition of intangible property, because they end up kind of taking what I call a sledgehammer approach. We look at kind of depreciable assets and say, hey, that's not intangible property, and then everything else is. So there's really this broad approach or broad stroke to what is intangible property. So that's just my personal opinion on why they actually made those changes to 42. But that's it when it comes to transfer pricing. They didn't change any of the documentation requirements, any of the methods. Everything else really stayed the same. So implications of tax reform, that's really, I should say, implications of transfer pricing in regard to U.S. tax reform. So first and foremost, we had a major reduction in the corporate tax rate, and we're going to be talking from a corporate perspective primarily here today. So that dropped from 35% all the way down to 21%. And we're going to spend a lot of time walking through some examples of why that's important. Next, we have something called GILTI. It's the abbreviation or acronym for Global Intangible Low Tax Income, which, believe it or not, I attended a class last week that actually some people argue in certain situations GILTI is a good thing, but for the most part, Congress, their intention was to have GILTI be a disincentive to locate functions, and specifically intangible property, to lower tax jurisdictions. So that would be, well, let's move on to the next one. The next one is what's popularly called FDII, Foreign Derived Intangible Income. I will refer to it as FDII going forward. This is really what Congress intended to be the incentive to locate functions and IP in the United States to serve the foreign markets. So to keep that here, to move it here, this was the incentive. So this would be the carrot to GILTI being the stick, as I should have copyrighted back in a year ago in January of 2018, so that I could earn some royalties on that saying. But I digress. So FDII or FDII is the incentive to GILTI being the disincentive in regards to shifting functions and risks outside the US or back into the US. Next, there's something we'll talk about just real briefly. It's called BEAT, or the acronym is BEAT, and it stands for Base Erosion and Anti-Abuse Tax. It's really an alternative minimum tax or form of an alternative minimum tax when it comes to intercompany payments. But there's some qualifications that I guess I'm assuming a lot of people on this call won't hit, and most of my clients don't hit that threshold. So we'll talk briefly about what it is, but let's not spend a lot of time on it. And just kind of really in summary, U.S. tax reform is applying lower rates to broader bases of assets and functions and risks. So they're really taking that lower rate and applying it to income that is coming back to the U.S. or staying in the U.S. via GILTI or FDII. Which brings us to polling question number 2, Amy.
What changed to the transfer pricing regulation, section 482, as a result of the U.S. tax reform?
Yep, so the selections here are: companies can no longer rely on profit-based methods, documentation is no longer contemporaneous, the definition of intangible property has been broadened, or the arm's length standard was removed. So which one of those do you think was changed as a result of U.S. tax reform? Oh, okay. Well, just to be clear, the only real change to transfer pricing in regards to Section 42 is the definition of intangible property has been broadened. So every other answer is false. Just keep in mind that the only real change was that the definition of intangible property has changed a bit. So let's start in order of what we just described as the implications here. So from a corporate perspective, there's a flat 21% replaces the 35% tiered structure as of 12/31/17. So let's take a step back. So over a year ago, let's call it a year and a half ago, we would have been talking about different types of principles in terms of transfer pricing and planning. So typically we often had US companies that owned, started, developed intangible property or new products in the US and then took them to non-US markets or developed them for non-US markets. And we ended up with income concentrated in higher tax jurisdiction given the 35% corporate tax rate. So what we used to do is we used to try to justifiably shift functions and risks to lower tax jurisdictions. So if companies were expanding offshore, there was a smart way to do this. There were certain countries that had certain tax aspects that made it appropriate or more appropriate to enter those countries and to create really what we call we create supply chains or make principal type companies that would lead those foreign supply chains and really add value. And thus, by adding value, you could justify taxable income flowing to those lower tax jurisdictions. So that's where we were, and now we're 180 degrees, kind of the other direction. So, oops, excuse me here, going too far. So pre-2018, so this is where we used to be. So we had a US company. They developed a product and they wanted to sell it to a foreign country. Let's just say in this example to the United Kingdom. So if we had US sales of 100 of a product, let's just call it a medical type product, cost of goods sold of 60 and SG&A of 20, resulting in operating profit of 20, tax at 35%, and again, this is a real simplistic example, ended up with a tax expense of 7, so for your 35% tax rate. So this is what the kind of the global P&L for those product sales in the UK would look like before 2018, before US tax reform. So what we would do is we would, one method of is prescribed in the transfer pricing regulations is a profits-based method, but we would search for companies that perform similar functions. So in this case, we're just saying, hey, listen, what do distributors of these medical type products typically earn from an operating margin perspective? And then we're going to apply that to one of the parties in the transaction. So what you're seeing here is just a table or result of publicly available companies and their operating profit, their operating margins. And so what we did is we say, hey, listen, what do UK distributors of this type of product, what should they typically earn? Well, we say, listen, looks like 5% here. Let's go with 5% because it's within this range, the 1-year range, the 3-year range. 5% is safe. Let's go with that, and we'll apply it to our UK distributor. So mechanically, we look at, this is again the same P&L on a global basis, but we say, hey, listen, 100 in sales in the UK. So they should earn an operating margin of 5%. So that gets them $5 in operating profit. So the SG&A kind of is what it is. So this is what it costs to do sales general and administrative expenses in the UK. So we know that. We back into them what the price of the goods should be between the US and the UK, which would be 80 in order to get to our $5 of operating profit. So that is the sale from the US to the UK is 80. So following that down, the COGS are what they are. SG&A reduces likely, so it is 5. And in this case, we have an operating profit in the US of 15 times our tax rate of 35%. Tax expense is 5.3. Back to the UK, obviously at a 20% tax rate is dropping soon, but we'll just say for this example is 20%, and we get a tax expense of 1. So we have a total tax expense of 6.3 on this global P&L. So we've reduced it from 35% to 31.3%. So often, to take this a step further, again, this is pre-2018. We'd set up maybe the UK as a full-fledged manufacturer or principal type company. We'd say, hey, listen, we're going to license the IP to you to manufacture and sell these products outside the US. So the UK pays a royalty back to the US. So we change up the P&L here. So we have a royalty expense from the UK, as they're now the entrepreneur. We have royalty income coming to the US, but we don't have any other sales now that the UK sales in the US now that the UK is producing their own product. We do have R&D expense, obviously, as we continue to develop these products. And so our operating profit drops again to 7.5 in the US at a 35% rate, a tax rate of 2.16%. The UK now, they are now selling, let's just say, for example, through a related party in France. And so that same supply chain we had with the US and the UK kind of switches over to France here. We say, hey, France, you get the 5% operating margin, and we're going to back into what the price of the goods here. And again, we're going with 80 as the price of the goods, or it's what we calculated. The UK, their profit here is 15 at 20%. The tax expense is 3. France's tax rate, it's a bit higher. At this example, 33 1/3. But they're limited to their $5 in operating profit based upon the arm's length range that we developed. So they get a 1.7 in their total tax expense, and our total tax expense for this globally is 7.3. So now we've dropped to 26.5%. So just for comparison's sake, we have that here. So at the top, we have just U.S. selling to foreign non-related people, customers. Down to the left here, we have, if we just started a UK distributor, related party distributor, and then on the bottom right here, we have the UK as a principal company. We look at the drastic decrease in tax rates here. We have 35% down to 31.3 to 26.5. Again, this is all pre-2018 type of planning that we would do. So along comes the US tax reform, Tax Cuts and Jobs Act. And that corporate rate is now down to 21%. So let's go back to the same example here. So we have the US selling again to third parties in the UK. Well, we have obviously a tax expense that's dropped to 4.2% at a 21% tax rate. So what does that look like if we say, hey, what does it look like if we actually do the same thing and we create a UK related party distributor? Well, the UK's tax rate again is only 20%. So we again apply that 5% operating margin, same mechanics the way we did before, same price of the goods. Tax expense in the US is 3.2. In the UK, again, it's 1 for 4.2. So it's 20.8%. So now let's compare 20.8% with 21%. So hey, that's a bit of a reduction in effective tax rate, but this doesn't take into account all the expenses of starting up a related party in a foreign country. Obviously, startup costs, different risks you're taking. So to the extent that you're maybe not concerned about IP leakage in that foreign country, it may or may not behoove you from an effective tax rate perspective to actually start a related party. Maybe you want to continue to do those sales, from the US because we have that lower rate applied to a broader base of assets and functions and risks. So again, the incentive may or may not be there depending on what that foreign tax rate is. So let's take a look then at some other approaches. So let's just say, hey, listen, what if those distributors, what if they earned 3%? Or actually, probably the more appropriate way to think about this is what other percentage within this arm's length range could we actually apply to change things up here? Well, the US regulations explicitly say any point within this range from the upper quartile to the lower quartile is arm's length. So you can move any point within this range you selected. It's considered arm's length. So we say, hey, listen, let's select 3%. And in relation to, let's actually switch gears here. So let's look at an inbound example. So pre-2018, let's just say, okay, sorry. So on an inbound example, what we historically had done, given the high US corporate tax rate, is we'd say, hey, listen, in this reverse kind of example with a Netherlands company, they're selling goods into the US. We probably want to try to maintain a lower operating margin. So we say, hey, this 3% is within the range that we developed, the arm's length range. So we say, hey, listen, let's take that same example. Let's say if 100 on sales in the US, the US distributor earns a 3% operating margin. So that's their 3%. SG&A is what it is. And then we back into the price of the goods with the Dutch distributor, or sorry, the Dutch manufacturer. So their sales to the US would be 82. Again, the COGS of 60. SG&A is 5. And the tax rate in the Netherlands is 25%. So tax expense is 4.3. US expense is 1.1. You can imagine, obviously, if we had a operating margin of 5%, that tax expense is going to be higher than that. So our effective tax rate was 27%. So now post 2018, so post US tax reform, if we keep that same 3%, again, backing into the same example, the only thing that really changes here is the US corporate tax rate has changed to 21%. So the tax expense has been reduced to 0.6. So our total tax expense is 4.9, which is 24.5% effective tax rate. So it's dropped a little bit. But let's go back and look at that arm's length range that we developed. Hey, listen, what if, because the US tax rate is 21% and the Netherlands is 25%, is it possible for us to, let's say, increase the margins of the US distributor? Let's say to 6%. Well, yep, 6%, it's still within this range. It's below 7 there, below 6.8 there. Let's move it up to 6%. So what does that do? Oops, excuse me, fumble here. So we apply that 6% operating margin again here. Again, back into the price of the cost of goods between the US and Netherlands, it drops to 79. Our tax expense from the Netherlands perspective is 3.5, but it's only 1.2 from US perspective, so 4.7 overall for a 23.5% tax rate. So just minor shifting of operating margins for a US inbound company, so a foreign-owned US company, if you actually increase your operating margins, it actually reduces your, possibly, in this case, or this example, reduces your effective tax rate. So if you think of a company or a country, excuse me, of let's say like Japan, where your corporate tax rate is still in the 30s, you have a much lower tax rate in the US, you may want to think about increasing your margins, justifiably so. Again, we do these analyses frequently, these benchmarks, and as long as you're staying within that arm's length range, you can adjust what your operating margins or your markups, what those should be. As long as you can justify them within that range, you could actually change them. And the question I frequently get around that is, well, do you need some kind of business change or justification for that? And you really don't. Again, the US regulations say you can change those range, that point within the range anytime you want, as long as it's within that range. Again, just to kind of reiterate, just kind of show you what we just kind of did there. We have a 3% operating margin up to a 6% operating margin, and this is the reduction in the effective tax rate on an inbound example. So polling question number 3.
Awesome. Okay, so polling question number 3. As a result of the lower U.S. corporate income tax rate, companies might change their transfer pricing to?
They might change their transfer pricing to increase profitability in the U.S., move functions and risks to the United States. They might think twice before increasing profitability of foreign subsidiaries, or all of the above. Well, it's all of the above. Good job. So really, again, when it comes to U.S. tax reform and a lower corporate income tax rate, it really depends, of course, on the other side, the other country we're talking about here. But all of these things you're going to want to think about in terms of your transfer pricing. So you may be able to actually increase some profitability, and it may result in a lower tax rate. So just keep that in mind. Moving along. Okay, so now we're starting in on what's called GILTI. And again, these are international tax changes, and these aren't things that have been added to the code specifically for transfer pricing purposes, but transfer pricing has implications for these, and these have a lot of implications for transfer pricing. So we're going to walk through them, try to keep it high level. We're not going to get too far into the weeds, hopefully, on international tax, but we do need to kind of walk through and explain what they are. So GILTI, in a nutshell, it's New section 951A. Well, that's a new it's a new type of subpart F income, and really what that means is it's a new way to tax income outside the U.S. If it really doesn't have some really purpose outside the U.S. So subpart F used to tax passive type activities outside the U.S. And really GILTI is trying to tax income that, I guess, in lack of a better way of describing it, should be taxed, or some people, or at least the IRS and Treasury and Congress think should be taxed within the U.S. So one important thing to note here, and one really important thing to note for a further polling question, hint, hint, is that there are special rules, and specifically there are deductions for C corporations only. So GILTI applies to everybody, individuals, flow-throughs, S corps, C corps, but there are special deductions for C corps that we want to make sure everybody is aware of. Oh man, there's a lot of words on this slide. I don't know who built this thing. So really, I think we should just focus on the fact that well, you may or may not be a 10% owner of a CFC. Actually, I should say you may not have before, but you may now under U.S. tax reform. So those definitions have been expanded. But what's really important here is that a C corp will be allowed a 50% deduction on their GILTI until the year 2024, and then that deduction drops a bit, 13.5% after that. But there is no deduction for individual shareholders. So let me repeat that: no deduction for individual shareholders. So if you're not a C corp and you have a 10% or greater owned CFC, you might have quite the large GILTI tax expense from 2018 forward. Now, what we often see for individuals, flow-throughs, and S corps is that they've done something called check the box, or they for tax purposes have a flow-through entity in a foreign jurisdiction. But if you haven't done that, then you might have a large GILTI pickup for 2018 and beyond. So just something to be aware of. The other thing to consider is that the tax credits are only 80% under Section 960 going forward, so you don't get 100% foreign tax credit against taxes paid in a foreign jurisdiction. But net for a C corp, it should result in no residual tax paid if the foreign rate is at least 13.125%. Again, that's C corp. For individuals, it's much higher, and it's a much less favorable. So I guess the question then is, so what in regards to transfer pricing? Well, there are certain rules when it comes to GILTI. There are high tax exceptions, and so there's a lot of planning that can be done in regard to GILTI and transfer pricing. So the first step, honestly, and we've had a lot of clients that we've done this for, is doing some modeling, because the way the calculation is done for GILTI is they take a 10% of what your depreciable assets are in the foreign country, and they say, okay, that's not part of GILTI, and then everything else here that isn't subpart F or previously taxed, that's considered GILTI. And so a transfer pricing analysis and a modeling exercise can say, hey, listen, what should we be doing? What functions and risks should be located in a foreign country? Do we need to revisit this? Do we need to pull some stuff back to the US? Obviously with substance, possibly contractually, but either way, we got to take a look at this. We got to make sure that our functional analysis is correct, and maybe from an effective tax rate perspective, we need to really take a look at where we should be locating our functions and risks. So that's kind of the main takeaway when it comes to GILTI. FDII. So it's a new Section 250, and what it is it's a preferential treatment, again, for C corps only, and again, for polling questions, please note, for C corps only, you get a special deduction for activities that you perform in the US for the benefit of foreign entities. Well, I'm sorry, for foreign customers. And so what it comes down to is it's an incentive to export stuff out of the US. It's an incentive to make stuff or have the US companies make things and sell them abroad, or perform services for foreign customers or related parties. So I think when this first came out about a year ago, we were thinking this was just for U.S. to third parties in foreign countries, but it actually is for related parties as well. As long as, if let's say an item that you're selling to a foreign related entity is sold in a foreign country, it's not sold back to the U.S., or that product or that kind of mid-level supply chain product is taken, added to something else, and then that end product is still sold only in the foreign jurisdiction, then you get the actual FDII deduction, again, for a C Corp. And the deduction results in an effective tax rate of 13.125%. So it's akin to what we had called kind of a patent box in other foreign countries. So anything, and again, the calculation results in looking at everything beyond a 10% kind of swag at your depreciable assets, and anything above that can be considered FDII income, which qualifies for 13.125%. So clearly 13.125% is much less than 21%. So that type of planning where you're doing more in the US and can justify more under your FDII income clearly gets you a lower tax rate. So again, similar to GILTI, you take a look at the functions and risks. Is it something that should be located in the US, or at least contractually should be being performed in the US, or the US should be compensated for that? Are you a startup company, or are you just thinking of expanding your product globally and you're not sure where to locate certain functions and risks? Well, maybe you want to take a look now at keeping certain functions, R&D or high value type functions in the United States, so that you can take advantage of that 13.125% tax rates. If you're a C Corp, again, this does not apply to individuals or S Corps, flow through type entities. So you can get that reduced rate. Now, I just want to point out it's not a complete 7 7/8 benefit, because you have deduction certain expenses that you have to apply to the lower tax rate versus 21%. But again, you're getting at least down towards that to 13 to 14% a tax rate versus a 21% tax rate. So again, it all comes back to your functional analysis and deciding kind of who's doing what and where. So just kind of a summary. So GILTI and FDII and transfer pricing. So there's disincentive to locate high value functions offshore, and there's incentive to locate high value functions in the United States. So whether you're shifting that after the fact, or you're at a point where you're expanding internationally, it really behooves you to think, where should these occur? And really, again, what's so important, as we discovered in the last year, is modeling these things out, doing a model with solid projections. Again, we repeat that, solid projections in terms of your foreign sales costs and profitability and your US sales costs and profitability. Model that out and figure out what makes the biggest sense. I often get the question, well, how long do we think, do we think this stuff's going to last? Do we think GILTI and FDII, are they going to be around for a while? And my gut instinct is yes, they're going to be around for a while. I mean, just thinking about, we're back to a split Congress, Democrats in the House, Republicans in the Senate. So we're probably not going to get a lot of changes for at least the next couple of years. And then from going forward, even if things, let's say, shift more to, let's say, a Democratic-controlled Senate and House, we're still likely to get something that takes a little bit more time and is more thought through than really what happened in late 2017 and really just a period of a couple of weeks where the U.S. tax reform was decided and voted on and surprisingly actually passed. So it's going to be around for, I think, at least another 2 to 3 years. So there is some planning that can be done in regard to this new regime. Which brings us to our last polling question, and I gave you guys a lot of hints on this. So, Amy, let's hear it.
Last polling question: what type of U.S. entities received additional deductions after U.S. tax reform?
Yeah, so there are certain types of U.S. entities that get certain additional deductions as U.S. tax reform: partnerships, S corps, C corps, or sole proprietors. Which do you guys think gets special deductions? The answer is C Corps. So only C Corps get additional special deductions when it comes to GILTI and FDII. So keep that in mind. A lot of what we're talking about here deals with C Corps. Please, I'll repeat myself here. When it comes to GILTI, if you're not a C Corp, you really need to take a look at it. Well, if you're not a C Corp and you don't have flow-through entities, foreign entities, for tax purposes, so you haven't checked that box, you really need to pay attention to your GILTI. You could have a big hit on GILTI in 2018 and going forward. There's still some things you can do. If you haven't done some restructuring or did restructuring before the end of the year, there's still some elections you can make on your tax return. I'm not going to go into those, but reach out to us and let us know if it's looking like you're going to have a big GILTI tax for 2018 and going forward. Next, we're going to talk about BEAT, and BEAT is the kind of the last major change or kind of implication or kind of disincentive that Congress came up with. And I swear we have the best, when it comes to international tax, we have the best acronyms. So we have, if you're GILTI, you'll get BEAT. We have FDII as well. So we, as part of U.S. tax reform, the international portion got the best acronyms, if as far as I'm concerned. So BEAT is really kind of an alternative minimum tax. And what I want to point out, and this is important, because I'm not sure it'll apply to a lot of people, not a lot of our clients. We have a few, but in order to get hit with what's called the BEAT, you have to have average annual gross receipts of at least $500 million for a 3-year period, ending your previous tax year, and you have to be a C Corp. So again, this is an instance where it's not necessarily favorable if you are a C Corp. So if you are a C Corp, again, and you have a 3-year average annual gross receipts of at least $500 million for the global enterprise now, keep that in mind, then if you don't have that, then you're not going to get hit with what's called the BEAT. So, but what is it? Well, really it's targeting what's called base erosion. So again, if you think about the incentives of Congress, or the intention of Congress and what they're trying to do is they're trying to, again, broaden that base in the US to tax more things, but at a lower rate. So really it's an alternative tax that says we're going to look at a percentage of your foreign payments to your foreign related entities. And really this kind of comes into, I think, more commonly in situations where we have foreign-owned U.S. corporations. So you have a foreign-owned U.S. C corporation making payments, let's say, to a parent company for, it could be anything, obviously, like we talked about earlier. It could be services, could be the selling of goods, could be paying for manufacturing. But very importantly, we came across this in a client situation, is paying interest on intercompany loans to, let's say, a foreign parent or any foreign-related entity. So if your percentage is a certain amount, and we're not going to go through the calculations, but if it's above a certain amount or a certain percentage, then you have to pay at least a 5% additional kind of taxable income from 2018 and going forward. So 5% for 2018. In 2019, it goes up to 10%, and that goes through 2025, where after that, it actually increases to 12.5%. So you can see how this could become, between 2018 and 2026, could actually become quite the detriment to inbound companies or just companies that don't have their foreign payments kind of set up correctly. So let's take a further look at this. So again, implications. So inbound or foreign-owned C corporations. Now, where we ran across this, I think we weren't totally expecting this, but pay attention to any acquisitions. So you may not be above that 500 million in average gross receipts, but let's say you're acquired, you have a client that's acquired, or somebody's acquired by a foreign corporation, and that company actually does have greater than 500 million in gross receipts. Now all of a sudden you need to pay attention to the BEAT. You need to actually do the calculation and figure it out. The second thing that I think we often find is that people are thinking about the sale of goods. We forget about the intercompany financing, the intercompany lending. And especially in the acquisition scenario. So we had a foreign company coming in by a client, and they tripped that $500 million annual gross receipt kind of threshold. And then, oh, by the way, they loaded them up with intercompany debt, and they're paying a bunch of interest back to the foreign parent. Well, that interest payment is an intercompany payment. It counts. And so even though the U.S. company was in a net operating loss position, they still ended up having to calculate, and they're going to have to pay BEAT for 2018. So so these are just some things to think about. I know that it's not likely applicable to a lot of people, potentially even on this call, but it's something to think about. BEAT is just another one of those kind of disincentives, or again, it's actually meant to broaden the base, but it is again a disincentive to actually have payments going offshore. So I just want to kind of summarize everything, and really, so I mentioned early on in the presentation about the functional analysis. So really, we have U.S. tax reform, which has changed, let's say, everything. But really, the more things change, the more things stay the same from a transfer pricing perspective. So we really need to go back and do a proper functional analysis. And to the extent that nothing's changed on an annual basis, that's fine. But let's at least take a deep dive and figure out, hey, who's doing what and where? Do we have high value functions in the United States or elsewhere? And let's take a look. Should they be located in the United States? And really, are they truly high value? Let's take a deep dive and see what those are, and we'll lay those out so we can kind of justify, where we're locating certain profitability, or where the profitability lies, to really take into account the U.S. implications of tax reform. Now, what we haven't talked about is there's a flip side to all these transactions, right? So we do have U.S. tax reform, but what about the foreign side as well? Well, we need to pay attention, because you can't just make changes without justifying them. And again, that's where the functional analysis really comes into play. And so we need to be able to justify any of these types of changes that we make, so that we're not creating any exit situation in a foreign country, or a situation where a foreign tax authority is saying, hey, wait a minute, I see you're making these changes, and perhaps justifiably so, but we may be paying less tax in this country, and we need you to justify that. Or you're making a big change here, you're shifting things out of my country into the United States. What's the reason for that? Has there been a business change? Is there another reason, or is there a reason to support this? If not, you could face, and from a foreign side, you could face certain exit charges that say, hey, listen, you used to have a higher taxable income because you had certain functions here in the United States. Well, we're going to be foregoing that in this country, so we want to make sure that we're getting our fair share. Again, that word fairness comes back into play, that says we want to make sure we're getting our fair share, and you're not just shifting stuff out of our country. The other thing that's interesting is that we actually have had some pushback globally on FDII. So again, I think I mentioned that it's sometimes referred to as a patent box. Well, certain patent box regimes in other countries have gotten criticism for unfairly trying to bring taxable income into a lower tax jurisdiction. Well, certain countries outside the United States now are saying the same thing about the US. You're saying, hey, listen, you're creating this massive incentive to shift income or shift intangible property to the United States, and we don't like it, and we don't think it's fair. And so from a world tax perspective, a global tax perspective, there's some rumors or some discussion about FDII being disallowed from a foreign perspective. So we haven't seen that yet. There's just been kind of grumblings about it, but we'll have to keep an eye on it and stay tuned, and we'll keep you informed in further tax webinars. But just things to think about. It's definitely going to be around from a U.S. perspective for a while, but you do need to think about the foreign side when you're thinking about all these questions, or these the modeling exercise. We really need to model it out and make sure that we're not triggering any penalties or creating any undue risk by making any wholesale changes just due to U.S. tax reform. So that's really kind of it when it comes to transfer pricing. Again, we could spend on each of these topics: the corporate tax cut, the GILTI, FDII, BEAT. We could spend a lot of time on each of these, but I think we've done a good job of giving a high level perspective of what it means from a transfer pricing perspective from all these U.S. tax reform changes. So I guess we'll open it up for any questions, Amy. I'm not sure if we can open the lines or if there's another way to ask questions.
We can use the questions box located on the right-hand side within the GoToWebinar toolbox. You can also use the chat option. And I don't
great.
see anything quite yet, but I'll let
Yeah,
you know.
happy. We have plenty of time left, so I'm happy to take any questions that somebody might have. Well, I think we have contact information. If there are any questions, don't hesitate to reach out. Otherwise, we're not getting any questions in thus far, so I think we could probably go ahead and end it. Is that okay, Amy?
Yeah, we're good.
Thanks very much for attending. Really appreciate it. If you have any questions at all, please do not hesitate to reach out to us, and appreciate your attendance today.
Awesome. Thank you, everybody.